So let's go ahead and get started. We'll have Annie underwrite one of the deals that we have acquired with Sounder Investment Group. And we'll also talk about um, Jason's offer on that property. So let's go ahead and get started. Go for it, Annie.
Okay, I will share the screen now. Thank you so much, Faye, and hello everyone. Yeah, thank you so much for arranging these sessions because I'm able to share what I'm doing every day, what I'm enjoying doing every day with everyone here, which is the underwriting the deals, multifamily, and yeah, I was kind of very fortunate that I got trained and I yeah learn from different models, so I'm able to share with you what I know today. And in case if you have any questions during the when I'm sharing or present, just just ask, and if the question right on the point that I'm talking about, I will answer. But if we like your question is like a few steps ahead, I will just wait until we reach there and I will answer your questions.
Yep, and feel
So
free to put in the chat whenever you have that question so we can cue them in. And yeah, just let's do it.
uh, hang on, Faye, I have a sorry, it has some technical issue here.
Yeah, and while she's doing that, I trust everyone is well. I just landed in Chattanooga, Tennessee. Always a good sign. I didn't see Samuel L. Jackson when I got on the plane, so that's very promising that there were no snakes. And yeah, it's what else was I going to touch on that? It's been a very long day, but always looking forward to bringing the heat and the value on these calls. We have several individuals that are had a quick. Well, I'll ask you offline at some point, Raphael, how that deal is going that you're currently working on. But yes, so is this deal that Annie is breaking down is the one that was bought 2.5 years ago for 3.35 million. And last week we just sold it for just over $5 million. And I was curious on people's offers that they did have submit. We had Jason's offer, which was 2.5, yeah, I have some questions about your underwriting because if you can get this deal for 2.5 million, you could even get that 2.5 years ago, which was a great deal, and to get it now. So if you could get that, you would probably go to jail for some reason because that would be an absolute steal. So yeah, I would be curious in your underwriting, but as Annie goes through this, I'll just provide some insights because if your offer is that low on that deal, then that would, of course, be affecting your other deals. Because, yeah, 2.5, if we would have bought that, what, 2.5 years ago, our cash on cash would have just been outrageous of that. And then to offer 2.5 now that the property's gone up. So, yeah, just curious on your underwriting, how you're able to come to that, because hopefully because it's likely that that's affecting your other deals that you're working towards, and it could be the financing or something else. But all right, Annie, so let's go ahead and go into that deal that you're the analyzing.
Yeah, thank you, Sterling. And so I know that there are many analyzer in the industry, and like for me, I came across a few as well. Like this is this is one of the model that I use. Before this, I used to use the Lone Star analyzer that I've seen that some of you over here also use it. But once I come across this one, I feel that this is like more easy, like easier for me to understand, and that's why I choose this model that to share this with you. So in case that you still not familiar with the model, just let me know, and I will go slower. Yeah. And before when I start underwrite any deal, what happened was like I used on the road underwrite so many deals before, and some of the deals I got the offer offer accepted, but like I have to walk away because of once I do the due diligence, it's find out that the market, the location was not good. So for that reason, I add another spreadsheet on top of the analyzer to learn about the market, to learn about the locations that over there. So any deal come across to my hand, the first thing that I do is like to learn about the market over there, and especially like when you do a lot, like for example, Sterling focus in Indianapolis, and like for me, like this is not my market, so I have to study, you know. But if you do a lot, you know very well about the market, maybe this doesn't need anymore. So what you're gonna check when you do the market analysis, you check for the populations, how well is growing from 2000 to 2019, then how fast is growing. You want to be in the location that the market and the population is growing, right? That means people moving in, and then more job coming in, more income producing. So you want to be in this kind of market. Then also check for the median household income, the price of the condo or the house in that area as well. So that is the big pictures of the market. But you know, like real estate is very, very I would say that hyper location. That means it's very small. So when you analyze the bigger ones, you want to go down to exactly the location where your properties is located, because like in some location, in some market, it's changed from block by block. So this block, the incomes may be higher, but then as soon as you go to the next block opposite, then the incomes immediately change.
Yeah,
So for that,
and quickly, I want to touch on this, and I'll be inter jumping on these, Annie, and do appreciate you for jumping on here and analyzing this deal and providing your insights. It's greatly appreciated. Is that, and there's some people that aren't used to markets such as Indianapolis. They may be out in California, for instance, or some other market where they cannot understand that. Okay, what do you mean by it's street by street or block by block? But however, in this particular market, that does happen. And I see some people say, well, I just want to blanket analyze deals there, and I want to use rules of thumb. In this particular market, it's very difficult to use rules of thumb when you're pulling comps, you're doing analysis, because I like to use this example that when my mother moved my brother and out from the inner city to the suburbs, we were still in lower income housing. Literally, we were in one school district, which was Decatur Township. Right across the street, literally, was another school district. So that's what I mean, how different things can be. And you could be in IPS public schools, and if you don't understand the actual, you've taken the macroeconomics and you've looked at that, and now going down to the actual neighborhood, if you don't understand that as well, that, okay, this is IPS schools right here, and then this is Lawrence Township, it's a significant difference. But if you don't do the proper analysis on the neighborhood basis and you're looking for rules of thumb, that's where you can start to get in trouble. So yeah, there's some moving parts where now you have to dig a little bit deeper to do your further due diligence. So yeah, that's what all I had on that, Annie.
Yeah, thank you, Sterling. Like so continue with what Sterling just say. Then when I do the Google search to locate where the property is. So in this right here in Southport and Madison Avenue, and I would go to city data and try to pull out exactly where's the location, where's the block that it belongs to. And I look at the median household income in that area, and also see, like I screen capture it here so you can see it easily. So in this area, this is right here. This is the location where this property is located. And you can see the median household income right here is 52,000, which is really good. Like if it's
For
in
Indianapolis
between,
too. Yeah, very good.
in between like from 40 to 70 in this range, you will have a very good like this is what you're targeting. And also um, the median household income, you look at the unemployment rate over here, and the contract rent, the how much that the average the people here is paying, and also the poverty level, to make sure that people here has a job, and they able, if they stay here, they able to pay the rent to you, you know. And here also like have a good mix of the population, like majority is like mixing between the white people and Asian. All right, so it's past now. Now let's see with the
And one thing I also want to chime in on this particular location, it's Southport, Indiana, and it says Homecroft there. That's just another why you would have to be local. But there's Indianapolis, but there's also some places, and I know there's other markets that do this too, is there's some parts of the city that so Southport, Indiana has its own schools, it has its own police department, but it's still in Indianapolis. So it's one of those things that it's really somewhat a city within a city, but it's not really a big city or anything. So that's one thing that people have to understand, that one, that it's in Indianapolis, but it has its own schools that are actually better than the Indianapolis schools. So that's why you got to do your extra due diligence, and you really have to have some local knowledge. And that's why it's good to have some boots on the ground, or a team that could help, a property management company that could help provide you those insights. Because if you overlook that, then that could be something that could really affect your deal and what you could offer, because you don't really see the upside and the differences between, let's say, the schools, or let's say the median income, which is what Anna went into.
yes. So now let's get back to the underwriting. And here in this spreadsheet, basically like all the main information that you input, anything that is in blue, that means it's the place that you have to input the information into. Asking price, okay, vintage, the name, address, the year of the constructions, asking price, how much, and then like purchase price, like here I just you can put the same price as the asking price, but along the way when you finish the underwriting, you will see the return and adjust the value here to meet the return that you looking at. Here the debt informations, another rate, and like just forget this part for now, okay. We will go to the unit mix and the current P&L, and we come back to that tab again later on. So over here in this spreadsheet, that is another input. It show the you know, like the rent rolls, how much is the unit mix, what is the current rent, and what is the target rent that we're looking at. And I would like to emphasize here as well is like some of the OM, like they have the information about, like most of the OM, it has information about like the unit mix and what is the current rent, and what is the pro forma that they're looking at. But always a best practice to look at the current actual rent roll that they're having at the time that you buying that properties. For example, right now is in May, right? Try to get the most updated rent roll, because like you want to know how well it is doing at the current time that you're buying. What if like you have the old data, but right now the condition, the situation changed, the property is not doing as well as before anymore, and you're looking at the old data and you will be paying like overpriced. You pay much more than what the value should be. So try to always get the latest information that we can get. And also like some of the properties, if you get it especially when you do the cold call, right? To the direct to the seller. Many of them, they don't have OM. So if you able to get a T12 or rent rolls, that's perfectly good. That is more than good enough. Like the OM is like, is nice to have, but it's not necessary that you need to be able to have that on the OM file.
Yeah,
And
and I want to quickly touch on this. I would say this deal in particular, I don't think out of the deals that we acquired, the 46 unit, the 50 unit, the 280 units, this being one of the 80 units and 156 unit, it was all put together. There was no OM, the rent roll, the financials were all, we had to make quite a bit of assumptions and piece it together. They did give us necessary context, but many of the times is we were, I wouldn't say shooting in the dark, but some of the information they gave to us is we had to dig deeper and say, okay, you don't have the full picture and the T12. You've got like the most recent 3 months, but now let's look at your bank statement so we can actually verify the income. So, okay, now let's get your actual statements from the utilities. That way we're able to get that. So that's the pros and cons oftentimes, that when you're buying on market deals, you have a broker that helps you obtain all that information. They make it pretty like this. This is Michael Wernke, who we're working with. And however, if you're going direct to owner, that's the difficult component that you do have. But I've always enjoyed that. And plus, I've had people on the team that we can shell that off to that can help with the underwriting. But yeah, that's often what you'll come into with mom and pop operators, that they'll provide you maybe maybe they've been doing their financials on a loose leaf paper. So yeah, that's one of the types of things that I would say to expect when you're dealing with mom and pop owners. However, if you start to deal with more sophisticated operators, that's when they'll be able to say, okay, they'll be able to send you all that information because they have it all in like a property management software of some sort.
Yeah. So like for this this OM, the rent rolls that I have here, in this case, for this deal particularly, I have the rent rolls in hands, but then the rent roll is like kind of I will show you why I'm using this. So so this is the rent roll that I in the file that I received, but I'm not able to use this rent roll. So whatever that a number that I'm having here, I pull them out from the OM. And the reason that I'm not able to use it because if you look at here, the bedroom and bathroom here, like many of them like 2 bedroom but 0 bathroom. So I don't know what is the unique mix over here. So I don't want to I think that there's something wrong with this rent roll, so I'm not using this one. So instead of that, I was using the one that is show right on the OM and input, like type out everything into the file here, so that we have a more accurate number to look at. Based on the rent roll in the OM, I'm able to pull out the detail like this. So if you see, I have like 4 units of 4 units of 1 bedroom, 1 bath at 525 square feet, 2 1 bed, 1 bath, 575, and even like 36 1 bed, 1 bath, 720. And if you look at the OM, you will see the difference over here. That they put everything, 1 bed, 1 bath into like the totals here, and they get the average. But I want to be very accurate with my calculations, because this part is very crucial, because it's determine how much is the current rent that you're having and how much that you can increase. So let's say if you put it like instead of 700, but you put it 750, and you're able to increase only up to 800. So instead you're losing $50, like $50 with the cap rate of 5%. You see how much it is. So I want to be very accurate with my numbers because this is important. So this is what I observe. And when I input based on the rent roll that we have in the OM, I pull out the current rent, assume that this number is the correct numbers. Okay, so you always have to verify whatever that we have, always have to verify with the owner. Then the current rent average is 694. That come with the annual CPR is $666,000. And the target rent is 736. Here is like how can I come up with 736? So this come into two area. One is the current rental here. You see, like some of the units is asking for 700, let's say 760, but then you only get to 700, for example. That means that you have $60 that you can increase to maximum achievable, right? So that's one part that you can look at. The second thing is like after you renovate the units, how much more that you can increase the rent higher. It's going to be higher or it's going to be the same. So this one, the second part, you need to not only on the rent roll, but also look at the comp set as well, the rent comps, to see that the same characteristic properties in the same area, how much rents that they're having right now, what are the amenities that they're having, and how well they're doing, and what is the gap that we able to achieve comparing to their properties. So that's what I want to explain over here.
Yeah, and the thing on this particular property is we've executed just about a large portion of the value add. So more so, the person who's coming in is we've done a two-tone paint scheme. We've did the countertops and updating. We put a backsplash on it. So we put vinyl plank flooring. I know there's some units we were not able to address because there's still the new buyer that could come in. But this is more of someone that's actually coming in and parking their money. And then also just that the simple fact that the rents are just gradually going to be able to go up, and that at a certain point, yes, we did push those rents up, but we haven't pushed them over some of those the years since the rents have started to go up. So that's one thing you have to factor in. And yeah, this is actually, I mean, that's one of the units, but there's other ones where it's actually more updated than this, where there's vinyl plank flooring throughout. No, this isn't it.
Yeah, this one is the upgrade one, I think. Look at the
but it's not showing the actual, because the the living area. So the living area on one of those has the carpet, but there's some where we actually went in and put vinyl plank flooring throughout. It doesn't have those pictures on those that we did.
Yeah, I understand. I just want to share this photo with the group because like when we do the capex estimations, because right now like everything is just like the very first due diligence that before we submit the offer, right? So we don't have really exactly numbers and like go tour and really go there and visit the properties to have the more accurate numbers. But by looking at the unit here, you see like the floor, what type of the appliance that they having, the kitchens, the countertop. You can have approximately numbers, like some number that you estimate in your mind that, okay, how much that I'm going to spend, and look at the condition of the units, Yeah,
and that's one of those things you can get from your property management company, but you can know that, okay, I am going to have to go in just make an assumption on all the units. If they're all in this condition, that I'm at least going to have to raise just for the interior loan 3,500 or 4,000 or whatever your costs are going to be, and you would raise that for capex to then turn those units. Or if you're doing, let's say this was an outdated unit and you're putting in gray paint scheme, you're doing vinyl plank flooring, you're resurfacing the cabinetry, you're replacing the countertops with Formica, then in that case, depending on your construction and all that, but just using rough numbers, that our property management company, they said that they would be anywhere between about 8,000 to about 9,500. So now you have those estimations in the back of your head and knowing that, okay, this is the interior loan. And then as you're doing your due diligence, you start to tack on, is it an older roof? How's the plumbing? What's the HVAC look like? And then you start tacking those other things on, and then you would bake that all into your assumptions.
Yes. Also, in the OM, it's mentioned that 48 units already update. So that means we have 32 units left for the next buyer to renovate and increase the value. So like for that, like you don't do the capex for the whole 80 units. You just plan for 32 units left only. Yeah, and also now let's go visit the P&L. So this is the 12 months P&L T12, and it's in 2020. So again, it's always good that you can get the latest T12 up to April or May. Let's say if it's selling right now. Another things that stealing, let me share the way I do it, and then like maybe you can add the comments on this, because the way I underwrite with the way I look at the P&L is, like we're gonna ask the lender, they will be the one that who approve for our loan, right? So I want to make sure that the way I underwrite the deal very match very well with the way that they do the underwrite, right? So with the lender that I've been working with, they look at for income is T3, but then for expense is T12. How is it selling? Do you have, is
I
your
would say that
lender
again. I didn't
same?
catch that. I zoned out. What was that?
The income the lender look at is just T3. So you get the last 3 months of the income and multiple get the sum of the last 3 months and multiple with 4 for all the items in the income side, and then for the expenses you take the T12.
Yeah, that is one form. My part, and this is why it's key to have a team in place. Is I have a partner that deals on the underwriting and coordinating with the lender. And essentially, what you said does make sense. I don't have too much how they had underwrote that. I can go back and actually pull how specifically they did that, but I don't have the answer to that on underwriting to our lender standards because that was their side of the business.
Yeah, okay. Yeah, so this is the way that I underwrite, because I know that my lenders, the one that I'm working with, like she does like this. So yeah. And that's why you see here. And always it's a best practice, okay? Because I've seen many, not many, quite a few P&L T12 that they have the total here. But then if you sum them up on the 12 months, the numbers doesn't look the same. So always the good practice to check, like get the sum first before you do everything. And yeah,
and this is why I tell people that underwriting is an art. We're at about 30 minutes in or so, and Annie hasn't even really got in depth on actually underwriting the deal. There's so much that goes into this, and that's why it's one, you yourself could learn this. And yes, you want to understand at a high level, or just bring someone onto your team to do the analysis, because it is an art. There's one, and I don't want to get too much into the actual trenches, but let's say Annie's doing this, and you see all those tabs that was there. You can stress test it. You can say, okay, well, right now things are trading for a 6% cap rate. Do I automatically assume in the future that cap rates are going to keep shrinking and getting smaller and compressing, or do I keep it at a 6 cap? And then you want to stress test, okay, what does it look like if we keep it at a 6? What does it look like when we keep it at a 5? And then considering the rent. So it's an art, you guys. And yeah, I definitely appreciate you, Annie, going into all the various scenarios and just talking from the beginning all the way until right now, and just saying that just looking at the spreadsheet alone is doing further due diligence. That one, you may look at the final column and you want to check on that final column, because it may, for some reason, a formula could mess up and it's not calculating. So now that's why you want to do a extra due diligence just to ensure everything is lined up. Because one mistake, and I shared this with you guys, and Annie touched on it earlier, is that I was too aggressive on one deal by $75 on a per unit basis. So that was $75 on a 156 unit apartment complex. So you do $75 times 156 units, and that's 1 month of income. And then you annualize that. We offered the owner $7 million based upon that. That is a huge swing on income. So if you make one mistake that such as that I made, that can really affect the whole deal. And there was one point where I remember going behind Jacob's underwriting. He did a great job with the underwriting side, but there was one formula that messed up, and it really just it didn't make a huge swing on the deal, but it was one of those things that came up on that affected the income. So yeah, it's an art, and to have key people on your team, because one thing that you could miss could really affect it. And this goes back to, I know I'm going on this tangent, but this is one thing that's very crucial, is there was guys that they were doing the underwriting, they were doing everything right in the due diligence. One thing that they did not calculate was the reassessment of the property. So meaning if it's currently being assessed at, let's say, 3.35 million, which it was roughly around that for us, the new buyer comes in and they're buying it at $5 million, it's not going to be assessed at this anymore. It's going to get reassessed here, and the property taxes are going to go up. So if you don't consider that in your underwriting, then that will heavily affect your cash flow.
Yeah, that's very important. Thank you, Sterling. So here, before I start with the D12, I normally, as a practice, I look at the like definitions or the name, that whatever that the items that they call here, because it's basically they more or less similar to each other, but then some have more information, some have less information, and some they use some other special words that I'm not familiar with. So I want to look at what they're using here and try to understand what it is first. So if you look at here, I have the explanation. Okay, accounting, where I'm going to put in the accounting, like where I'm going to put this expense into the P&L. Into the P&L for my calculation here. Right? There's no like accounting. So that's why I need to understand what it is. And by the time you do a lot more, you will get familiar with more of this. And if you look at here, like you see, I put the explanation. Okay, accounting, I will put in the admin column. Advertising and marketing, I will put in the marketing columns. Etc. Okay, so like common area maintenance, I will put it in under repair and maintenance. So like this is easier for you to track, like, okay, which item to go to which, and you will have the overall pictures of each item expenses, how much it is, how is it too high or is it too low for this type of properties.
Yeah, and also touching on this, what she exactly just touched on is when we were looking at the P&L from the owner before us, that how they were running the property, they actually had a lot of CapEx that were in this P&L. The thing that you're supposed to do with CapEx, you're actually supposed to pull that out because that's not going to translate to the new buyer. And what I mean by CapEx, such as upgrading the decks. The decks were all, I mean, out of all the units that were there, I'm trying to think how many decks were there, but those were in these expenses here. I believe it may have been in repairs and maintenance, which increase the expenses. And then you would look at that and say, and this is when you're analyzing a number of deals that, let's say Annie touched on, is after a while, you'll see, well, a C-class property that's in this type of location should not be at, let's say, the advertising costs here, or the repairs and maintenance shouldn't be up this. So yeah.
Yes, exactly. This is exactly that the point I want to touch as well. So if you see here, I have like, okay, after I put all here, I will pull the number and put into this spreadsheet. Then I look at overall. So we have everything here. We have payroll, admin, marketing, trash, electric, etc., like tax and insurance and turnover. But have a look. It's very interesting. Like Sterling just mentioned about the repair maintenance, is come up to 73,000 for 80 units properties, and it's converted into like they spend $920 per unit, which is extremely high. But because they don't have the detail that explain what's the item under the repair and maintenance, so we cannot question, so we cannot know that what at the expense. So this is something that you can go back to your broker or the seller and verify the number. Ask them, okay, exactly this, what this, and maybe you will be able to adjust this and put into the capex expense. And by this is the opportunity for you to improve the operating efficiency when you get into the ownership of these properties. So here's the actual numbers from that P&L, that T12, and I convert into here. Now we do the pro forma. So in this tab, whatever that in this column, basically it's just I pull out from here. So basically this is the actual, and here is year one is the pro forma that we estimate how different, how change, like how much it should be as the rule of thumbs and average expenses in this area, in that area particularly. What I mean by that is, like, for example, payroll in some locations, some market like California or Texas, you know, the payroll can be very high. Like you pay the staff over there, their salary is higher. So you have to expand. You have to understand the market, how much it is over there. Let's say if like some location is like 1,100 or more than that. But in this location, maybe you just spend $750 to $850 for the staff annually. That is good enough, right? So you again understand the market is so important. General admin. Normally, I will look at the total of general admin and marketing together. So as a rule of thumbs, and with the properties, like 95%. For how long already, and how much I'm going to spend for the marketing, and how much I'm going to spend for the administration. So it's very somewhere between from 150 to 250 for these two items. Then you can just adjust on this. Normally I do trash and all the utility expenses like similar, but then account for the inflation, you know, like a few percent for the inflation. Management fee, again, it depends on the size of your properties. If you have the smaller size, like 50 units or less, maybe the management fee will be higher, like at least 10%, or even some of them go up to 12 or 15%. But if you have like 150 units or 200 or more, then it can come down to 3%, 4% to 5%. But in this case, we have 80 units. So and right now they're paying 6.5%. And I think 6.5% is sufficient, is good enough for this type of units, this type of properties. Next one is the repair and maintenance, contract service, and turnover. This, I normally look at these three items together, and averagely in the market, this number the total will be vary between 800 to 900 for this type of 1960 to 1970s construction properties. So if it's newer, like 90s or 20, yeah.
Annie, quickly, can you tell the difference between those three?
Oh, yes. Repairs and maintenance, basically like what it is, why, like how it's called, like you repair something or you maintain something in your properties. The contract service is like you will do for the landscaping, swimming pool, like all the maintenance for, and more routine, like you have to get somebody to maintain it monthly. The turnover is
pest control.
Pest control also under contract services. Turnover is like makeover, like you have the tenant return the units, right? And then you need to make it up, make it nicer, put some cosmetic and painting, and like some units have the pets, and the pet biting the windows, like you need to refurnish it. So this kind of cost, I'll repaint the unit. So this kind of cost is going to the makeover for the units.
Yeah, and another word for turnover is make ready, which is, as Annie mentioned, once the tenant moves out, you go in and you turn the unit. That's another technical term. When you go in and turn a unit, that goes to turnover.
Yes, and in this case, like you see, the current owner that paying $920 per unit for the repair and maintenance, and $600 for the turnover, which is extremely high. And like it's 95%. And again, pull back the rent roll, see like how often the tenant moving out and moving in, because this affect this value as well. But I assume that the tenant, like the turnover, not that much, not that so busy that they must have the turnover up to $600. So this is something that is the opportunity for you to come in and improve it. Then so I adjust the pro forma based on what I think it should be. But again, whatever that the number that we put in here, like because when I get into the meeting with the sponsor or the investor, they look at each number and they're gonna ask, okay, Andy, I have here like 920, but you decrease it to 400 only. That means you reduce more than half of the expense. Tell me why you do like this. So you need to have a good explanation and good understanding why you adjust the number like this. It's not just like, oh, because like this is the way I do it and I already done it a lot, so it's like this. This is not the answer that we want to give to our investor or the sponsor on our deals, right? We need to have a valid explanation. Maybe we can say, like, maybe after we do the investigation, we find out that okay, the properties over here is too high because they put the capex under the repair and maintenance, which is it should not be there, right? So when you give this kind of answer explanation, they know what you're doing, and it's build trust and build more confidence from the investor to invest with you. Again, another questions that I observed from these properties is the tax. The tax in this area is very high, like $1,000 per unit. So because this market I'm not familiar so well, so I don't know if it's like is it average like this or is just something going on. I don't know. But if you're familiar with this one, this area, like maybe you can help me with this.
And you mean taxes in relation to the overall expenses, or you mean taxes? Because in Indianapolis, I would say it's very affordable to somewhere such as Chicago, Detroit, California, New York. So that could be subjective, but it's just 2%. So it's non-owner occupied. So it's just 2% of whatever the. So is that what you mean, Annie? Or
No, I mean like because like many properties in Texas, the tax is like something that make the deal or kill the deal, you know. And when I look at over here, the tax is like $1,000 per unit. Is if this is like how much they it's been charged, and this is the same for everyone, all the properties in Indianapolis, then I don't have any question. But again, because I bring this up because I'm not familiar with this area. So I just want to ask. Yeah. Insurance. Insurance is like also depends on the the area and also the history. Some of the one of the properties that I looked at a couple of weeks ago, what happened was the insurance was low at the time that they put on selling. But during the time that the property is on the market, what happened was there was 4 units burned out. And because of that, the insurance immediately jumped up very high. So when you get onto the deal, you need to know like look at the insurance. If it's too high than the other properties that you look at in the same area, then questions what happened with these properties. Does it have if it has any claim before, or something, if there's something wrong, or the conditions with the property, is there something that make the insurance rate so high? You know, you need to verify with your insurer.
Yeah, and
Also, yeah.
I'm glad you're mentioning about asking the questions and digging deeper, because what I've experienced is if something seems off, there's a reason why it's off. And that's for instance, on this exact property, there was one of the tenants that was there was some fraudulent things that were going on here. That one, and this is between everyone on here, that one of the managers was actually on drugs. And then the other person was one of the tenants that was living there was their son. And they were doing some like printing off some checks and like saying the son was paying, but they weren't actually paying. And we started uncovering those types of things during the due diligence. Like this isn't adding up. And then when something's not adding up, then start subtracting and start digging a little deeper. And then as we were asking questions, we saw that, yeah, there's something fraudulent that's going on here.
Yeah. And especially like some area also in the flood zone, you know, or got hail with the weather, and you know these kind of things will affect your insurance value as well.
This property got hit by a tornado, and the top of it got completely ripped off. Actually, when you're looking at this property, Annie, if you could go back to the OM, there was actually apartments that were sitting in front. So if you could go to the OM where it has the aerial view.
I think it's
it's somewhere in there, but you'll see that it's like this, like a U, but there was actually apartments that were sitting out in front of it that got hit by a tornado. Yeah. So towards the well, it would be the south end. Yeah, it's the south end on here too. So towards the bottom, there were actually apartments that were there that got hit by a tornado. This was a while back, and actually it wiped those out, and then also ripped off the top of these apartments, and they had to get newly more so constructed. So those are all the things that you'll uncover in your due diligence. I don't know why I brought that up, but yeah, just giving you guys a little bit of history on that, I guess.
Yes. So after you have your pro forma. Now let's work on the capex and reserve. And so over here, because I don't know like exactly how much is the cost, the material, the labor. And by looking at the photos only, and I just estimate, okay, how much I'm going to spend for each unit. Then because it's only 32, so I assume that maybe just spend 5,000. Maybe it's too little. Maybe it's more. So if you want, but here is come to the based on the experience, and also ask the property management like that you work with, and ask them, okay, I project like this. How do you think? Should I increase or decrease? That they will tell you. And also, you need to be like how can I say? Let's say you need to look at how much rent that is can increase in this area. Let's say if these properties or any properties that they can increase only $50 more on the rent, but you spend $10,000 to upgrade the one unit. Is it worth it? How much is the return on investment for you? Right? You don't want to spend like 10,000 just to increase only $50. And as far as I know, like the return on investment should be at least 20% to be valid, like valid to go with. So this is one of the things that you need to pay attention to as well. So here is the capex that I plan for interior and exterior. And by looking at the photo, and you will tell like how much the exterior is gonna be as well, similar to the interior. Next one is the reserve. Okay, the reserve depends on the way that you operate your properties. But like so far, what I observe is like when you just take over the properties from the ownership of the properties, right? It's maybe take from 1 to 3 months for you to transition, like for the team there, the staff over there, and everything that goes smoothly. Of course, it's as quick as possible, but then like sometimes like because during the transition you may have some hiccup in your expenses, or like something happened, right? So you need to have some reserve. It's called operating reserve. So maybe like 1 or 2 months that you put. And if you can raise it in advance when you raise the capital, it will be very good. You just keep it, and for the situation like this.
Yeah, and what I've experienced when you're going in, especially a property that, and this was about 90 close, it was 90 over 90%, so it was stabilized when we acquired it. But oftentimes what'll happen when you go in there on the property that is mismanaged, it was still mismanaged, you'll acquire it and you'll see that the team may not be a fit. As mentioned, one of the managers was on drugs, and she was actually a hoarder, and she for the longest time did not want us to walk through her unit. And when we finally walked through the unit, it was very tight. There was things everywhere, and we had to walk through. It was, yeah, that was quite the story. And then the other person was embezzling money, and so we tried to keep them on, but once we dug further and we found all that stuff out, so there's that you'll experience. And then also that there'll tend to be a drop in the occupancy, because you're going in, it's likely that that previous operator loaded up the property, maybe offering incentives, got some renters in there just as a way to get them in there to make the property look better on the performance side. And then when you go in there, you're starting to implement some people that were dragging along making the payments. You're saying, okay, now we actually need it at this set time. Those people, you'll have to evict those. So yeah, that's why it's good to have some type of reserves, but also know in your underwriting that that's going to happen. Because I see also often that people believe that everything's going to be all sunshine and rainbows when they're acquiring deals. That the very first 46 unit deal is that winter was one of the worst winters in Indianapolis. We were not expecting that. that affected our rehab. We went over on rehab, and then by us, what is that? By us not being able to do the rehab, that affected our timetable and the returns to get to our investors. So everything ended up being a snowball effect on that. But it's just knowing up front that everything's, so if you buy a deal that, okay, all of this needs to go right, best wishes on that. And I'm just saying that to be diligent and just always to protect your downside.
Yeah, that's true. Also, another reserve that I would like to touch on is also the reserve required by the lender, because this was not required by the lender before COVID, but right after COVID hits, then the lender reserve, they call it COVID reserve, and it's I think that right now it's changed, but before a couple of months ago, it's required 12 months of P&I, principal and interest, that you have to raise and put in the reserve with the lenders, that they're gonna keep it after 12 months, then they will release it to you. But right now, I think it's reduced now to 6 months only. So always have the with the updates, this is can affect the return as well. And let's say if you have to raise like another a year, another 12 months or 6 months of just interest only on P&I, then it might affect the return. So what I normally do is, as a strict, like, for example, instead of raising the capital for the capex and all the reserve, I will reduce the amount of the capex that I raise. But instead of that, because eventually after 12 months, right, the COVID reserve will be released by the lenders. I will use that money instead of return back to the investor. I will use that one for the capex. So you don't need to raise the money so much at the beginning.
Oh, was that a question, Annie?
No, that's not a question.
Oh, okay, gotcha. I didn't know if you had asked the question.
But yeah, it's so quiet. So I don't know if anyone have any question. Okay. Yes. So now we have this, and then let's get back to the first tab. So everything in the other tab got linked over here. So you have like reserve, capex, a acquisition fee, how much money that you will put down from once the offer got accepted. How much is the acquisition, if it's syndication deal, how much is the acquisition fee? Depends, like some people like take 1%, some people take 1.5 or 2%. So depends.
And there's other
Assessment.
fees.
Yeah.
There's other fees that you can do. You can do a construction management fee.
Yeah.
You can do a loan guarantor if you're signing on to the loan. There's so many ways. So if an investor says, well, you guys are charging too much for an acquisition fee of 2%. You could do a loan guarantor fee of 1% and the acquisition fee of 1%. So that just goes to show you that but really what it comes down to, and I remember speaking with, well, I don't want to go too much into it, but there's just knowing what your end goal in mind is, and that will allow you to charge what you want up front. Ongoing asset management fee, acquisition fee up front, as long as you're getting your investors to, and we have the numbers here for Annie that has the LP returns. As long as you're hitting that LP returns, that's where you can reverse engineer and say, okay, well, I can't charge as much on the acquisition fee, or I'm not able to do the ongoing asset management fee. But you want to ensure that there's enough meat on the bone for you to make money as an operator for putting it together. So if you're not able to charge these up front, you got to eat. You guys got to eat. So from there is, if the deal doesn't make sense for you to be able to do that, then that is a good indication for you to just move on to the next, because you don't want to be in a deal where it's good that your investors are getting a return, but hey, you're not getting anything from managing and putting your dollars into it, managing it, finding it, and then doing the ongoing reporting to the investors.
Yes, that is very important, Celine, because even when I talk to the sponsor as well, this is the questions that they ask, like what's in it for me, like how much I'm making, because like they want to know how much they're able to make, right? Like Celine say, like you'll be on the deal for 5 years, and all the return that will, all the cash flow return we get, like go into the LP, and we GP, we don't have anything. We need to eat, we need to do the work as well, right? So yeah, we need to make money. We here in the business, we're not in charity organization or something.
Yeah, exactly. We're for profit. If you're nonprofit, which I don't see too many people, but you guys get it. You're for profit. You're entrepreneurs and you're capitalists, for lack of a better word. So yes, for you to earn money for providing a service.
Yes. And yeah, so for this deal, particularly with the requirement, like get the stabilized debt from the lenders, with the rate right now is 7.35 to 7.8%. I tend to put higher because I want to be conservative in my numbers. Like let's say by the time that you close the deal, the rate is increased, right? So I just add up a little bit the cushion on top of this. So I put like 3 point, yeah.
And that's very key. And I know I keep jumping in on some things, but I don't want some of these to be glossed over, because this is important, because there's lenders where there's a rate lock that you can get, but most times you're not able to get that rate lock. So let's say when you're first initially underwriting the deal, which has happened to us before, I'm trying to think whether it went up or went down, but when we initially underwrote the deal and then we closed on it, 90 days later, rates do change. So that's also something that you want to have in place, because that could really affect your deal. A couple basis points really does go into your cash flow. I believe on one of our deals, or one of them, the interest rate ended up going down. I believe another one, before we actually closed on it, actually went up.
Yes, that's very important. And we don't want, like, we get on to the deal and at the end, like the deal didn't work out, or we have to look for different lenders to find a good rate or something. Is very pain in the ass. Yeah. So IO 36 months. This is something, another thing that I also if you want to be more conservative, you can put like 0 IO or 12 months IO only, because if 0 IO or 12 months IO works, for sure 36 months IO will definitely work. So this is like how far you want to be conservative with your underwriting.
What is IO, Annie?
Yeah, interest only. Sorry. Yeah, that's interest only. So depends on the lenders, like they give you like maybe 12 months of paying only the interest. And then after 12 months, and then you start paying the interest and the principal together. Some lender will give you 36 months of interest only. Then after 36 months, then you start paying the principal and interest.
Okay, yes, I will meet you there. I will be out there shortly. I will be in a great.
So for this deal, when the asking price is at $4,950,000, is didn't give me the return that I look for. Then you see the cash on cash and the rate of return drop. So I want to adjust the price to see that how much I'm paying to hit the return that I'm targeting. So depends on the group. Like if you're investor, some of the investor like very comfortable with like just 7% of the return or 12% of IRR, you know, like sorry, 7% of cash on cash and 12% of IRR, or some group that will be like 14% of IRR, or 8% of cash on cash. So it depends. It doesn't mean like you have to be like more than 8%, you have to be more than 50%. No, you need to understand what is the target returns that you're looking at and your investor looking at, you know.
Question, Annie. So
So in
what's the
my case,
difference?
yes.
Oh, what's the difference between the cash on cash and IRR?
The cash on cash is like so this is the return that you have, return on the total investment that you put out into the deal, and then the interest rate of return is taken into the factor of time. Like you put the money like after 2-3 years, then you get back and convert it into right now, then how much it's making, and that is the return with the factor of the timing.
All right.
Yeah.
So yeah, cash on cash, and you mean IRR would be the internal rate of return.
Yes. And like for this, asking price, it doesn't work for me. So I just try, let's say if I buy it at 4.5 million, then yeah, it looks good, right? It looks good. Another way you can play with it is like in Excel, it has a goal six, you know, goal six feature. I don't want to go into detail too much, then you will all confuse. But I just want to let you know that yeah, you can play with the numbers and get the return that you want. And because right now we are in the seller market, and then like I don't see like many deal that is how can I say it? It's like it's very hard nowadays to buy extremely low unless like that property is nobody managed or it's really in bad conditions. But most of them nowadays is selling at the market price, and if your numbers doesn't work at what they asking, and even if you go down below like 10% or 10 or 15% and it still doesn't work with you, then just walk away, and like don't put the offer like 60% or 70%, sorry, 20 or 30% much lower than what asking price, and you know it's maybe they get upset with you, like you know what you're doing or not, or something like that, you know. And one of the tips that I would like to share with you here as well is like how can I say it? Here in real estate, like in multifamily, everything is come to the relationship, right? So when you want to make like the seller is in, unless that you deal with direct to seller, that's another story. But if you work with the brokers, right, you want to make the brokers looks nice in front of the seller. You don't want like the brokers like you keep asking, you keep ordering the brokers, but you never submit any offer. You know, always have a good communication with the brokers, and if the deal doesn't work with you, tell them, let them know that okay, I underwrite like this, like I would like to share with you, and please see if where I can improve or something. Always give the feedback to the brokers and build a relationship with the broker this way. And if you can submit the offer, just submit the offer. Like even for those properties that you don't plan to buy, but still submit the offer, make the broker looks nice, but submit it like not too low to make the broker looks bad in front of the seller, but it's high enough for you not to be chosen as best and final. So this is one of another tip that I've learned when I work on the deal like as well. So yes, I think that's all for my presentation today.
I agree. Relationship is really important. You don't want to, burn bridges, especially that real estate is really small. It looks huge, but literally it's just a small portion of all other businesses out there. I do have one clarification for you, Annie. So in this part of your calculator you have there, and this is for those that are would actually want to syndicate and structure their deals, um, raise capital for their deals. My question for you, Annie, is on that part in column K, where you have the total equity shares,
Yeah.
the P hurdle, like the member split for LP and GP. How do you identify that, and what would be your basis for it? Like, how do you make the adjustments based on
Oh,
your
you
yeah, how
you
do you
can
decide on it?
you can adjust the return over here. Depends on the what returns that your investor looking at. Let's say if your investor is comfortable with 8%, then you can adjust it to 8%. If your investor in comfortable with 7%, then you can adjust it to 7%. And here is the because this is the benchmark that is set, and this is the return from the LP. So if your return is 7%, but then the cash on cash just hit only 6%, it will not be able to sufficient enough for the project for you to have a good return to the investor.
And the LP, when you say LP, that means
LP mean a passive investor.
Yeah, limited
and
partners, and then you have
Limited partner, yes.
and then GP is the general partner. But this is very key right here, and I've mentioned it several times, that always having the end goal in mind of one, if you're doing your own deals with your own money, understanding what your end goal is, what your cash on cash. Okay, you sell the property in 3 to 5 years. What return would you like to see from that? In addition to your cash flow. So let's say year 5, you want to double your money. Or in this case, let's say that we've got here, it says class B, but the projected returns, that's more so, yeah. So let's look at the projected returns. In this case, if Annie wants to have the internal rate of return 18 to 21%, I'm just throwing it out there, and the cash on cash to be 11%, then either she could go up and play around with the equity splits as a way to boost up the investor return, but then that goes into her getting paid as a GP, so she has to factor that in. Okay, does it make sense for us to earn this? Or she would just go back and adjust the purchase price. But it all stems, and I wouldn't recommend adjusting the rehab price. Some people will go into that and say, well, we can actually do less on the rehab, or actually we can be a little bit more aggressive on the rents. That's where people tend to get in trouble, when they're adjusting those things versus adjusting the things I just mentioned with the purchase price, or maybe the splits. But it all comes down to what you want to give to your investors. And it also is on a deal by deal basis, but typically on a C-class property, and things have been going lower. And then also this is market dependent, but let's say comparable market to Indianapolis, C-class property in a B minus to B neighborhood, internal rate of return ranges anywhere between, and this is other syndicators because you're also comparing with them too, is between about 15 to 20% on the IRR, and the cash on cash could be anywhere between about 8 to 11%. So you have those in the back of your mind, and then you underwrite deals and you reverse engineer to now get to that. So it all starts with that as the end. You've got to know what you're wanting to get to your investors, and then everything you, in essence, back into your purchase price, your equity splits and preferred returns or hurdle rates, all that to get to that.
Yep.
All right. And I believe Jason had one question that said, so reserve 6 months of your mortgage, but Jason wanted to jump on and ask some questions.
Yeah. So I was looking at Annie's analysis and my analysis, and the difference is mostly in the rehab cost, because I have actually talked to a contractors, and they told me that it's going to cost about 9,100 per unit to update each unit. That is why my rehab is so high. And also
Yeah, one thing I would say, Jason, is you'd have to factor in how many units need that, and all the units don't need that type of upgrade. There's actually how many it said in there, Annie, that need to be upgraded?
32 left.
Yeah, so there's 22 left. So I'm not sure if you use that figure across all 80 units. But yeah, these are the key things in due diligence that you have to really have your I's and dotted and cross, because yeah, that really affected your offer of $2.5 million, which when Annie was mentioning earlier about if you were to submit that to Worky, he probably wouldn't even want to work with you, like ever, from a type of offer like that.
Yeah.
So yeah.
You guys were saying that only 22 of the units need to be updated, correct? Also, Annie is using a 30 years amortization at 3.8%. And if you are a first-time investor, you are not going to get 30 years amortization. You're going to get more like a 20-year at 4.25. So that is
on this deal, you will be able to get better. I would say minimally 25%, but that's also one thing that really, what's that word I'm looking for? Financing is key. So if you have a lender where you're able to get, let's say, interest only, but still I wouldn't bank on that so much, but a longer amortization rate, you're able to get a lower rate. That also affects what you can offer to. And that was one of the things that was affecting us on the earlier deals is everyone had more aggressive financing than we did, which of course they can be more aggressive in their offers because of that. So if you're this interest rate is 3.85 and they've got, let's say, that amount of interest only that's on there, which increases their cash on cash and cash flow. And then their amortization rate is longer and you're at, let's say, underwriting it at a 20, your interest rate is a 5, then that's a huge swing on the deal. And then also on top of that is you've got your renovations that are 9,100 for all of the units. So yeah, that is a huge swing in what you can offer on it.
Okay, and so like those are great points, and I will talk to my broker about getting a 25 instead of a 20.
Yeah. And by me knowing Worky, I've worked with him several times. He's one of those brokers that he's got a different personality, great guy. But yeah, if you were to submit that offer to Worky, he probably wouldn't want to. That's what Annie was mentioning earlier about the style of how to submit it, and it's a relationship business that some brokers they will not be happy about. They would not. And it's the same with owners, but it's a double-edged sword. But that's what I wouldn't want you to get into that scenario, Jason, is that based upon your underwriting, you're being lower and then you're submitting that, and then that could affect your reputation.
I think that that already happened with me, and the warranty already starting. So I think it's too late for that now.
Well, it's a learning lesson, and there's abundance of brokers out there, so you're all good.
Yeah. I am studying. Thank you very much for that.
Oh, for sure. All right. And I think you deep had a question way back when that said, "Oh, I have a question about the napkin sheet. Is you deep still on here? Let me see. Yeah, you deep.
Napkin sheet. No, I didn't touch it because like I don't want to do things shortcut. You know, like napkin is just a quick calculations, and yeah, if it's past the market analysis, then I will do the proper analysis. I don't use it's there, but I don't use it. And basically, you just input a couple of numbers and get like approximately how much. But you know, like there's lots of things in the deals that you can look at, just not only like the asking price and the cap rate. You know, there's many opportunity, like lots of I mean, like opportunity that you can touch on, like for example, the operation efficiency, right? You see, like you can improve from there. So I don't like shortcuts.
Fair enough. And then Matt's got a question that says, "What is the price per unit on a similar bed, bath, condo, townhouse house?" Oh, yeah, that's quite a bit there, Matt. So, yeah, I mean, you got your houses, and then you've got your apartment units, and then you got your townhouses, and then you've got your condos. So those are all different property types, and here they all range on different prices. But for here is it ranges, I would say about 45,000 to about 65,000 on this a similar asset to Buck Ridge at Southport. So there's that. Houses around this area, I would say, and Annie may have this data to back it up, but I do know that minimally prices are, so they're about 80,000 to about 150 to 200,000. So this is one of those that is a step up from just the working class. It is a working class blue collar, but it's just right actually before you get to the suburbs. Some people may consider this a suburb, but it's really not. So yeah, I would say you're generally dealing with that price point of closer to about $100,000 on a single family house. Townhouses and condos, I don't know too many that are actually built out here for that. So I wouldn't have that offhand, Matt. I don't know if did you dig into that, Annie?
No, I didn't. Actually, I don't know the price point.
Yeah. Yeah, I would say overall, everything that you have plugged in here, you did a great job with that. So realistically, what would you offer on this? Is it the 4.5?
Yes, I will offer. Well, I would offer maybe like 4.4, and then like if I'm able to, if the brokers ask the brokers like, how do you think about my offer, and he would say like, okay, you too low, or maybe yeah, it's good, like 4.4, just submit, and then once submit, then like if we want to get to best and final, then maybe can adjust to 4.5, and you can like go back and look at the numbers, how much maximum that you can pay. You
Got it.
know, like let's
Well,
say if it's can, yeah, the highest offer that you can offer, then make sure that that's the ceiling. You will not go above that.
got it. Well, I would have to say, unfortunately, Annie, I will have to decline your offer. And so, but yeah, this did, and we had shared this a couple weeks ago. So this just sold over $5 million, so just under 5.1. How that person ended up buying it for that, we thought we were actually going to sell it closer to about 56, 57. And then the broker ended up coming in and said, "Nah, we can get this actually closer to about 62,000." And we got it for that. And as Annie mentioned, it's the seller's market right now. It's very low inventory. And then also, I've touched on this previously, is that I believe, well, not I believe, but real estate is a hedge against inflation. And we've printed off all this money and over the years and pumped it into the economy, and that now and this is just one of my philosophies, that the value of the money is going down, like the purchasing power, so it's taking more of this to actually buy things out there, and one of those is real estate, which is it's just gradually going up. So we'll see how things shake out. It's likely that since this what is that real estate's a hedge against inflation, things will just keep steadily going up. Because as you listen to people who sold their properties years ago, they say, well, I wish I would have held on to it. So it's the same thing in this case of people who are selling properties now. Is they're like, I mean, they sell them now, but then in the future, like, ah, man, I should have held on to that, because things are steadily just going to keep gradually going up. All right. So I would say that is just about it. Any questions or anything, or any final thoughts, Faye?
There's a comment from Jason. I made your correction, Sterling. I'm getting 3.5 at 230K rehab.
Got it.
Jason, my offer still got declined at 4.5.
Yeah. So unfortunately, Jason, I will have to decline that offer.
Hey, Sterling, the very last question, which is this kind of contradicts what you have been saying before, though, which is if you guys pay 4,500,000 for this property, then that's actually
I wouldn't pay that.
no, let's just say like that'd be 60,000 per unit, and if you are paying to live between 2.5 or 3.5, that is more in the 30 to 50K range. So like which one is correct?
I'm not understanding your question, Jason. So the average rents on this property, we'd have to go back 750, 800. So all in on this is what, 50, 55,000? So I mean, being around that isn't really necessarily a bad deal.
Huh. Okay.
Does that answer your question? Being all into that? I mean, that's what I would want to be all into the property. This person's in a little bit more than that. The average rents being on this property about 700, 750, I believe, close to about 750. Annie, were you able to see what the average rent was?
So the average rent is like the current rent right now is 694, and
Okay,
then
so
the target
700.
rent 736.
Yeah, so this person's all in right now, and they still have to put in renovations to the rates is just under $750. So for us is we're not at where it's currently at of 700. We're all into this property at 50,000. So it meets our criteria, Jason, where our numbers are at and where we would like to be on the property that's renting for average $700. For them, that's not what we're paying. They're a little bit more. They don't meet our rules of thumb. They must have other rules of thumb. Does that answer your question?
Kind of. Can I just schedule a 5-minute phone call?
Yeah, I would have Annie look over your underwriting to see if,
please.
yeah,
Really
or yeah, because underwriting, I can help with it, but it's better for someone such as Annie that really pulls back the curtain and goes into it like this. Because yes, you'll use rules of thumb, but I would say in your case, rules of thumb would not be as beneficial until you get the fundamentals, such as what Annie's doing here. You don't have to go so much into the trenches as what she's doing, but there's still some fundamentals that will help, and then you can start to go high level and start, okay, now I can go use some more rules of thumb.
Hey, Jason, you can send like you can message me in the Slack and then share it. I will help you look at together.
Awesome. All right, well, that's what the community's for.
Thank you.
You're welcome.
All right, everyone. Well, have a great one. I do truly hope you were able to get value from that. Everyone's a little bit different when it comes to the underwriting because it can get some people feel it's mundane. I can see Annie, she gets very excited and animated from it. Everyone has their different personalities when it comes to underwriting. For me, it's like, I don't want to be in spreadsheets. I don't want to do that. But you have people that just have a knack for it that, hey, give me a spreadsheet, give me numbers. I'll be able to run with it. So I do trust everyone was able to get value from that, especially if you are a numbers person, and greatly appreciate you for jumping in on that, Annie. So we will go ahead and do, well, Annie's got something, and then we'll do the signing off with Faye.
Yeah, thank you, Sterling and Faye, so much that giving me the opportunity to share what I like to do every day with everyone here. And yes, so if you have any questions and you want me to like touch more on into details, then just like where to reach me, right, in the slide. So yes.
For sure. Thank you so much, Anna. We really do appreciate it that you actually spend time to share your skills to everyone else in the group.